Headline reports say America's biggest financial problem is finally slowing down. But while the data looks better, the prices you actually pay aren't going back to normal. The latest Consumer Price Index shows overall prices actually fell by 0.4% in a single month. However, looking at the full year, the trend is still climbing at 3.5%. Costs are still moving in the wrong direction. This creates a confusing split. News headlines celebrate a cooling economy, while the average bank account continues to drain at an uncomfortable speed. Groceries, rent, and car insurance are still claiming a larger share of the average paycheck than they did just a few years ago. Much of this frustration comes down to how we define inflation and the difference between a rate of change and a total cost. To understand why life still feels expensive, we must look past the monthly percentages and look at the cumulative price floor we stand on. Consider a standard burger that cost $10 last year. In a typical growing economy, that price might rise to $10.35. This becomes a problem when those small increases are compounded by a secondary trend, wages growing at a much flatter rate. The financial pain Americans feel stems from this widening gap between the cost at the register and the size of the paycheck. Three specific forces finally slowed that price acceleration. First, gasoline prices dropped sharply, reducing the cost of moving goods across the country. Second, global supply chains finally cleared their bottlenecks, allowing businesses to restock components without paying a heavy premium for expedited shipping. Third, the Federal Reserve's decision to keep interest rates high for a prolonged period has successfully curbed overall consumer demand. When demand drops, businesses lose the leverage to keep hiking prices, forcing them to hold costs steady to keep their customers. Together, these factors acted as a powerful brake on the economy, preventing prices from spiraling further out of reach. But even with this progress, there is a catch. A cooling inflation rate is not the same thing as prices actually dropping. On this staircase of costs, the steps are getting shorter, but they aren't leading back down. The steep price hikes of recent years are now a permanent part of the economy. Goods aren't returning to old levels, they're simply climbing at a less aggressive angle. The rate of change has slowed, but we are now living on a permanently higher plateau of daily expenses. The Federal Reserve is now holding interest rates steady as they watch this new data. Their goal is to guide that inflation rate down to a stable target of 2%. However, if they keep the economy restrained for too long, they risk a reversal that could lead to job losses and a recession. Every new report is a signal that determines whether the system achieves a stable landing or a sudden crash. This cooling period provides relief for the stock market, as companies are no longer facing the same internal cost pressures. If the trend continues, future interest rate cuts become more likely, which would lower the cost of borrowing and business investment. For the average consumer, this plateau in price increases is the only thing that allows stagnant wages the necessary time to catch up. By understanding the difference between the speed of inflation and the actual price on the tag, you can make more strategic financial choices rather than reacting to a headline.